looks like it's 1 o'clock on the dot. So let's go ahead and kick things off. First of all, thank you all for being here. Thanks for really strong interest in wanting to be a part of this webinar. We know this is an extraordinarily challenging time for everyone globally, and particularly for our community of startups, investors, and corporates. One very quick housekeeping thing before we jump in. If you're not talking, can we ask that you please mute your microphone now? And that will just make it a clearer broadcast for everyone that's joining. So please mute if you're not, I guess, me right now. So I'm Nina from the Rabo F&A Innovation Team. We are very lucky to be joined by a number of leading food and ag investors across CPG, food tech, and ag tech, as well as some equity placement experts from our Rabobank team as well. So we really just want this to be a time to hear from each of them, to hear their perspectives, and of course, most importantly, to answer some of your pressing questions, many of which have been pre-submitted. I would like to hand it over very quickly to Anne Gravin, who is our global head of F&A Innovation, to give you her 30-second thoughts on what we're doing here today. And then very quickly, we'll move into more housekeeping and get started with our investors. So Anne? Anne?
Can you hear me? Are we good?
Yeah.
Okay. I know everyone's Wi-Fi is probably as stretched as mine, so I apologize if I'm cutting in and out. Thank you all for joining. I think Nina did a great job introing the purpose of today's webinar. Like many people, we're really trying to, at the bank, find new ways of connecting and keeping our communities together. Partially because that's what FoodBytes is all about, and that's what we want to be doing in the food and ag space, especially during what I would say are unique and unprecedented times. But this is really a call to action for all of us to hear what you guys want and what you need, and how we in our capacity can help serve that. I think we're really fortunate to have a number of speakers join us today who actually will have different insights, as well as some of our own internal folks. And we'd love to get your feedback post this webinar, one, to make it better for next time, but also to make sure that we can continue the dialogue if there are things that resonate with any of you that we can help facilitate more understanding and connection. I don't want to spend any more time. I think I've gone more than 30 seconds, but a big thank you. And I hope everyone is staying healthy and finding their four walls not too small right now. Back to you, Nina.
Great. Thank you, Anne. Over to Sonia for a quick note on startups that we may not already know in our network. Sonia, over to you.
And ag. So I want to send a note to all of you who might not already be in our network that we know creating connections is now more important than ever, and we'd like to learn more about you and your businesses. So feel free to leave us your information on the interest form you can find on our website at foodbytesworld.com if you're looking for more opportunities like this to engage with our community, including our pitch and pilot offerings, which you can also see more about on our website. So that's just a quick note from me, and I'd love to kick it over to Brad to kick us off.
Yeah, hey everyone. This is Brad Blomstrom with Untitled Chapter here in Boston. We're a food and ag tech VC fund, about $200 million in capital, team roughly split between the US and Europe. So I guess I have a couple thoughts about the current state of affairs, and then what we're telling our portfolio, and just kind of the state of the VC market in general. So I'll kind of do a quick run through of a couple thoughts in those three categories now. I guess first of all, in the current environment, I mean, this is truly unprecedented in terms of demand shock. I think the most recent GDP estimate I saw for Q2 is going to be over 20% negative, which, and probably people are going to be upwardly revising that number in terms of the downside. So just for reference, during the Great Recession, Q4 2008, I think was negative 8%. So this is about 3 times worse than what we saw, 12 years ago, just in the near term. So what people might see as extreme or extreme outcomes are actually probably the norm right now. I would say the upside for this group, it's a demand shock. So Q3, Q4, you probably recover some of that spending, and there's a little bit of just time shifting happening in that demand. And then as far as this group is concerned, food is, I think, hopefully relatively insulated as an entire ecosystem just because people are still eating. That's not really something that's avoidable. So the thing that this group needs to worry about, I think, mostly is how the mix is going to shift over time. So people will be eating in more. Restaurants are going to be severely challenged in the long term. And so rather than volume, people need to be worrying about venue and also price point and margin. So those are probably going to be long-term pretty negatively affected, particularly if you're talking about the restaurant category. Folks that go out of business in this are going to find very tight markets for lending to start new restaurants for the next couple of years. So outside of major chains and major brands, I think the restaurant category is going to face a significant contraction that's unfortunately rather permanent. As far as recommendations to the portfolio, the number one thing we've been telling everyone is just if you're in the middle of a deal, whether it's an exit or a fundraise, subsequent follow-on, get it done, kind of punt on terms. If you're arguing about escrows on exit right now, you're thinking about the wrong things. So if you're a founder, I would say over-communicate to investors the depth of whatever pressure you're feeling right now. Nobody's going to ding you for being unprepared for a pandemic. It's really just important to be on the same page as far as what the plan should be for the next year. As far as talking about the next year, upcoming year, I would say get to 12 months of cash, either by fixing your burn rate or finding other ways to kind of preserve cash through dealings with suppliers or vendors or whoever. And I would say as far as timeline is concerned, think in terms of time rather than cash. So how much time does a certain decision buy you in terms of burn rate? Because you need to kind of be able to ride out the current storm until subsequent funding rounds kind of shake loose, hopefully sooner rather than later, but in the next couple of quarters, it's gonna be very difficult. Lastly, I would say think about second order effects. So rather than just, hey, the world's ending right now, think about downstream effects for how this could be affecting you. So for example, we're invested in a business called Produce Pay, which is a lender to the produce category. Rather than taking the base level view that people are going to continue to eat produce and everything will be fine, you have to add in another risk criteria in terms of how many of their borrowers are focused on the restaurant end market versus selling to grocery, because that's an added risk factor right now that maybe we hadn't factored in 6 months ago when we were kind of developing underwriting criteria. So things like that, kind of think through what the second order effects of a lot of this is going to be. And then lastly, if there is a significant rebound as the market snaps back and economic activity hopefully returns to normal, make sure your supply chain is prepared for that, because a lot of your suppliers and people you rely on may not be on as good a footing as you are. And you want to make sure that if there is a snapback that you're able to capture that rebound, because it's going to be crucial to kind of building back up your economic health as well as a business. So make sure you're thinking about if there are things to do today to optimize what the world's going to look like 9 months or 12 months from now, take that opportunity while you have a chance to kind of breathe. Lastly, if I have a couple minutes on the state of VC, I think right now it's kind of chaos. We don't really know what the world is going to look like. So everybody's been focusing on their portfolio. New deal activity slowed down a bit. I think that's mostly because we don't know kind of what valuation should be. The NASDAQ's off about 20% from a couple months ago. VC valuations are probably above that, I would guess, in the 30-40% discount range right now to where they were. So right now, we don't know how to price deals, but that market will stabilize and things will starting to get done in a month or two, I would think. But if you're dealing with VCs right now, I'd say be patient because they're putting out a lot of fires. Just be willing to work through and hopefully be able to work on a timeline that works for them too, just because right now we're kind of trying to circle our wagons. and then hopefully we'll be able to kind of act more offensively, once we kind of get the portfolio in order and all of the current funding needs for our existing investments, kind of squared away. So I'll stop there. I know that was all doom and gloom, but I think food and ag actually probably will be all right through all this. It's just, kind of take a clear-eyed view at it right now, and you'll be better off a couple months from now.
Great. Thank you so much, Brad. And what we're going to do for everyone who's watching right now, we're going to quickly do 3 to 5 minutes with each of the investors. I think you saw this in the description, and just get a lot of different thoughts. I see even some of the panelists here writing down notes. We're doing the same on our end on the Rabo side. And then we'll have about a half an hour for questions from the group. So let's just move right on more to the CPG space and hear from Tom Spier of Boulder Food Group.
Hey everyone, Tom's here, and certainly appreciate everyone joining today's webinar. I do think that our comments are very similar to what Brad just explained. We're giving guidance to our portfolio to cut discretionary spending where they can. That's kind of a broad statement for certain companies that are under even more pressure because they're in more the discretionary product side as opposed to the staple side. It may require deeper cutting and harder decisions, but certainly we do feel like, given the dislocation in the capital markets, that getting deals done right now that we're not already pretty well along is going to be more challenging. That's not to say it's impossible, but it will take more time to get it done, and likely concessions that may not have been there 60 days ago. So those are kind of key items on the cash side. On the supply chain side, we're advising everyone to really try to find redundancy where they can. Certain situations that's easier than others, but now is a good time, if you haven't already, built redundancy into your supply chain to do it. And hopefully that benefits everyone down the road once this situation is behind us. And those are the key points. I don't want to repeat what Brad already eloquently said, and I do agree wholeheartedly with his positions.
I think that's helpful, Tom. We'll have even more time for Q&A, so you'll have time to jump in with more thoughts that may spring to mind after questions from startups. So let's keep moving right along and hear from Amanda Donohue-Hansen, who is with Cultivian Sandbox Ventures.
Good afternoon, everyone, or good morning for the folks on the West Coast. As Nina mentioned, Amanda, I'm with Cultivian Sandbox. We're a VC fund based out of Chicago. We invest from plant to plant, so farm to factory, anything from farm level, supply chain through to food manufacturing. Our perspective, generally speaking, is we continue to remain bullish on this sector, in that even in uncertain or volatile times, investors often flock to agriculture as a stabler asset class. And so we continue to see that capital, at least at a macro level, will remain strong in the sector. In light of the recent events or world situation, ag remains an essential activity. So in a lot of the news we see regarding orders and halting of certain operations, ag, working on farms, in manufacturing plants, facilitating the supply chain is an essential activity. So from our perspective, there isn't so much a question on demand. We think demand will shift, as some of the points were mentioned, like discretionary food choices might shift, where people procure their food will shift, but demand will remain there. And so supply will be a bit, supply chains will be sort of disrupted with this new normal, but we're optimistic. It's choppy, but optimistic that folks can rally around that. And so for us, we continue to remain bullish on the investment thesis that we need food and agriculture technologies and innovations that make the supply chain more efficient, sustainable, and by sustainable I mean environmental as well as economical, economic. And so we're going to continue to deploy capital and make new investments. I agree with comments made by Brad and Tom that it's difficult for us as investors right now to think about pricing. So I would say, pricing new investments, we're having to spend a lot more time thinking through scenarios with companies and understanding those sensitivities in the business models. So that I would say is it's not impossible to do deals, but we're having to spend more time and more scrutiny on those business models. And so what I would say too, what we're sort of communicating to our portfolio companies, and it would be the same advice to other startups, is it could take longer to fundraise. And capital markets 12 months from now, 3 months from now, very uncertain. So similar advice to Brad, we're also telling our portfolio companies that if you have less than 12 months, really need to look at start engaging with your investors to understand the levers you have in your financial plan to manage cash, but to the points made earlier, manage your time, the time you have. And with respect to fundraising, be open to raising more capital. It's not the time to be too concerned about dilution at this point, but how do you extend time as much as possible? And get creative. There's new sources of non-dilutive capital through the public sector and through other sources that I would encourage folks to take a hard look at. So in summary, we're choppy waters, a little uncertain, but we think that food and ag is a resilient and stable sector, and we'll continue to make investments in the space. And it's just the time for startups to be proactive and creative as it relates to financing and strategy.
Thank you so much, Amanda. Let's keep moving right along so we can get to your questions. Next up, another fellow Chicagoan, I'm sure I'm saying that wrong, Michael Lavin from Germinate Ventures.
Chicagoan, but Chicagoan sounds a bit more fun, maybe. So thanks for having me. It's probably the biggest Zoom call I've ever been on, so I'm happy to add that to my roster of accomplishments. So yeah, I'd agree with everything that everyone's saying. I think these are really unprecedented times. Given that fact, no one is really an expert. So I think there's going to be a lot of just being clever and being resourceful to navigate this by all of us, frankly. There is, looking back in history, certain certainties that you can apply here. And one certainty is that the people that adapt, the companies that adapt and survive and weather the storm will be best prepared to come out as winners and be the most fundable, most attractive opportunities. Being able to show that you've hit certain milestones, and even though you might have had an ambitious set of milestones and timelines scheduled, even if you curtail that back and you say to VCs coming out of this, look, we had this plan, but we made these adjustments, that just shows prudence. That is super noteworthy. That is incredible. I will 100% back those companies and understandably see that, like, hey, you still hit milestones, you still made progress. You maybe refocused certain priorities and did some more front-loading work on things you could do remote, not in the lab. We invest in a lot of symbiosis, so that's why I say that. So like if that's the case, focus on experiment design and so forth, and then later, be able to kickstart and really ramp up fast on your in-lab wet work. But just kind of taking this back, I think, a lot of macro perspectives were shared on the call so far. There's a lot of sharing around VC dynamics. I think, one area that we've talked a lot about with our portfolio companies lately is the VC dynamics, as well as some other topics I'll touch on. But with regards to VC dynamics, it's really important to think about the structure of these VC funds so that you can predict what will happen. VCs, these funds are set up in such a way where they have to deploy their capital within a certain period of time, which is called the investing period. That time is usually about 4 years. from the start of the fund life. So the fund life could be 10 years. Sorry, I'm hearing, oh, there we go. Thanks, Roderik. Sorry, I didn't call you out there. So the investing period could be 4 years out of a 10-year fund life. What a lot of funds are likely to start doing, which we've already seen start doing, is extend that fund life by another year. So they can go to their LPs in many cases. Sometimes this flexibility is built into their partnership agreements where they can extend by another year, get some more flexibility, especially if there's a quote, act of God, which this would definitely satisfy. Germinate is not doing that. We recently closed our fund at the end of last year. We were very well capitalized. We are going to be an opportunistic fund taking advantage of lots of investment opportunities. But you should be prepared that VC funds will be turning significantly inward and being much more patient to see more signs from the market that gives them renewed confidence to re-engage and invest. Until then, you're probably going to hear feedback that they're turning inward, focusing on their portfolio companies, stockpiling their cash reserves for their portfolio companies. So, you know, again, with regards to our fund, just to be transparent, we've always had a solid strategy of remaining very selective and very committed with our portfolio companies. So we've always had a mindset of at least 2/3 of our capital reserved for follow-on investment. So I think I make those points because having a solid strategy from the beginning enables success in any cycle. And I think it's no different in VC fund or startup, right? So I think it's really important to be mindful of that. And sorry, Roderik, are you trying to get our attention now?
No. Please go ahead.
I can tell. So that's some of the VC dynamics. I think, you know, in terms of practical positioning to the VCs, I mentioned being able to show prudence. But if you're in conversations with VCs right now, or going to be, then I would really highlight how you're a prime opportunity to be cash efficient and hit some of these milestones during the next 12 months or even longer. How you've revised your financial plan and the use of funds. You have multiple budgets, multiple scenarios that that allow flexibility, so that if there's a certain renewing of confidence, you can ramp up quickly and you know exactly what levers to pull on. And then in terms of financial products that could be clever, there's a concept that's used a lot outside of venture capital. It's called stable financing. When it's oftentimes used in M&A, where when you're closing an M&A deal, you have debt already lined up and packaged, ready to go for when an acquirer wants to acquire another business. That financing is already available and the terms have been set. So if you go to Silicon Valley Bank or Comerica or whoever, you can line up some of this type of financing potentially, although there's a big backlog right now. But you can basically start marketing your fundraise and saying, hey, I've got debt already lined up that ratchets up or down depending on what the outcome of this raise is. And so that could be something that gives investors a lot of confidence that if they write a check, that you have the cash wherewithal to go and succeed. And then if you're in conversations with VCs and you can tell that their appetite is waning, don't push it, don't take a no, because that might shut off the conversation entirely and it's hard to renew it. Just keep them warm, be patient, and say, you know, we understand. Why don't we just keep in touch and we'll let you know how things proceed. And that could be really advantageous. And that way you can always go back to them. That door is still open, but just keep them warm. Besides that, you know, we talked about managing burn. We're specifically telling our companies or advising, not telling, but advising that they create multiple scenarios with plans up to 24 months. But like I said, have flexibility to ramp up at any given time. We're also advising that they put together tactical continuity teams and continuity plans for the future of work. And I think that the future of work is a really important thing to consider here because I really believe that there will be lasting ramifications from this. And I also believe that pandemics like this will become much more commonplace in the future. It really highlights the importance of what we're doing and why we're investing in, against antibiotic resistance. And, we've talked with Amanda on a number of opportunities in that area with livestock opportunities. The future of work is going to be ever more remote. And I think a lot of the stigmas that are associated with it today or in recent past aren't really going to continue necessarily into the future. So continuing the future, building remote work and continuity plans with the long-term mindset versus a short-term transitionary mindset is really important too. And on that end, the biggest challenge is probably going to be translating the culture from the way it is today with the current work, or has been recently with the current conventional work practices, into a more digital forum. That will be a very big challenge, and we're helping our companies navigate and strategize all of that. And then really be proactive in uncovering opportunities. There already are a lot of companies, particularly in our space, that are all fluff and really marketing more than anything else. And they're also oftentimes the companies that have the loftiest valuations. Those companies are in a very difficult spot. And so there's opportunity to capitalize on that and to really be a company that has solid fundamentals, solid growth plan, knows the levers, and is hitting milestones, and is much more substance than marketing. And so I'll stop
Michael?
there. I think my time might be up, but
yeah, no, all very helpful. I just want to make sure we have time for Q&A, and I want to give a reminder to the 80 or so folks that are dialed in right now. If you do have questions about anything that's been covered, please put them in the chat feature, or you can put them in the survey link that we shared ahead of the call. Sonia is diligently checking questions in both places, and we have a number that we're going to kick things off with in a moment. But we have 2 more folks to hear from on the Rabobank side. I will ask from a Zoom housekeeping standpoint, folks that are investors who are currently not on camera, if you have the ability to turn on your camera, we would like to see you. The group would like to see you, so you don't sound like a disembodied voice. So yay, thank you. I know it's late in Europe. Hi, Daniella. So thanks guys. We'd like to hear just a couple minutes, I think 2 minutes from Daniella, 2 minutes from Roderik. Let's start with you, Daniella, from the Rabo Food and Agri Innovation Fund over in the Netherlands.
Yes, thanks, Nina. Yeah, I think a lot of good things have already been said by the other investors, so that's great. I won't spend on that too much. I think from my side, it's also, in a way, maybe to start a bit positive. I think not everyone around now has probably lived through such crisis, either being on the investment side or on the entrepreneurial side. So in my view, this is also an opportunity for everyone to see how you navigate the waters in these times. I think if you look at more early stage companies, specifically speaking more like pre-seed, seed stage, I think it's actually quite a good time because you now have a chance to build a very good product. There might even be less competition out there. And if you use digital channels to get as good feedback from potential users as possible, it's actually, it can be quite an interesting one. I think if you look at the more growth companies, you guys that are out there that are a bit more further advanced, maybe already have a small group of employees working for you. Yeah, that's maybe more difficult. Macroeconomic impacts then just have, can hit harder. And I think particularly sales growth will be challenging. The 2-3 times sales growth numbers we've seen over the past few years might be more tricky. So in that sense, retaining liquidity is key. If you look at F&A, I think also mentioned already, the good thing is people still need to eat. That's not going to change. And I think it's also a sector that, at least speaking from a Dutch context, often get quite good support from the government. The need for innovation is ongoing. I think, for instance, if you look at the AgTech side, things like remote farm management, data solutions, robotics are all more important than ever, and actually there might be good opportunity now because people are actually forced to work with those innovations because of like restrictions on physical presence. So it might even help in shifting the landscape. So yeah, just think about how you can actually play with those and jump on the opportunities out there. From the Rabo Food and Agri Innovation Fund perspective, yeah, I think it's been in line with what the other investors pointed out. So yeah, to our portfolio companies, we really say manage your cash runway. Good financial planning is key. Trim on, any medium-term burn that's non-critical for specifically R&D, but maybe also on the fixed cost side. And think about options in terms of, government benefits, grants that are out there. We are obviously part of the wider Rabobank. So, we try to advise our portfolio companies also with the help of our colleagues on the debt side. Work very closely with them on doing impact analysis. So I think that's, that's something that will be similar for everyone out there. For new investments, companies out there fundraising, I think, there's been a lot said about the landscape as well. Just be aware that there might be some VC funds that, are just more focused on protecting their portfolio now. So I guess it's always important, but now even more to really target the appropriate investor group. Think creatively about how you can get in touch with those investors as opposed to just, spraying your IM out there. Funds might actually do less investments because of this, this crisis. I think for us, it's less of an issue because we're fully funded by Rabobank. So for us, we're still open for business. That said, we always invest on a co-investment basis, and we're always looking to form the right syndicates to support a company. So yeah, now even more important to actually being able to form such syndicates and having enough capital around the table. So yeah, that's going to be definitely a focus point. I think valuations, I guess, they might come down a bit, and it's really key for us to get a good feel for the sensitivities and making sure that, that we don't do deals that are overpriced right now. But yeah, I think for us, still business as usual. So any questions after, let me know. Thanks.
Nina, you're muted.
Sorry. Roderik, thank you, Daniella. Roderik, do you have anything to add on in your capacity of working with lots of F&A investors across all the, the folks that we've heard from here today? Is there anything that you want to add before we move into Q&A?
Sure. Thanks, Nina, and I'll keep it very brief. To start, apologies for the snafu a few minutes ago. My wife's taking up all the bandwidth here at home, so I needed to move to my phone from my laptop. Having said that, so to your point, Nina, I'm a matchmaker for startups and high growth companies. So in that capacity, I do speak a lot with investors and companies in the food and ag space. I had a list of things I wanted to cover, but let me just keep it brief because pretty much everything has been covered by the previous presenters already. So let me just mention three quick things. One is, how are investors responding to this? So, of course, a lot of investors are more internally focused at this point. They're asking their companies to review internal processes, supply chains, have backups for logistics, that kind of stuff. But one thing I've heard what was quite interesting is that a lot of, and it's a term I don't hear a lot, is drop-off rate. And many brands and consumer-facing companies are moving from a multi-channel distribution model to a online-only model. And how many brick-and-mortar clients, brick-and-mortar companies are losing and able to transfer to online, that's kind of like the drop-off rate. And when reviewing businesses, I spoke to a few investors about this. They will use this rate as a proxy for brand loyalty, product viability. So if you're able to transfer your customers from brick to mortar to online and even grow online, that could be a good sign. Secondly, I just wanted to touch on whether investors are still open for business. So I'll make a few quick comments here. yes, investors are still looking for new opportunities, but of course they have less bandwidth as current portfolio requires more work. So most investors are kind of tapping their existing network. So you probably will get fewer inbounds from new investors, because most of them don't want to be perceived as tone deaf, of course, or insensitive to the current situation. And we also, of course, all acknowledge that most of you are 100% focused on guiding your business through this difficult time. However, if you're happy to speak with investors, we're happy to assist wherever we can, of course. One other interesting point I heard was about the difference between funds with committed capital and funds with uncommitted capital. I think you'll have better luck at this point, of course, with funds with committed capital. Some funds kind of struggle to do successful capital calls with their LPs, as their capital is tied up in probably 401ks or other funds that are, well, not doing great given the current public markets. Last point I wanted to mention is around corporates. I don't really have an answer to this question, but I'm kind of wondering how corporates are going to respond to this crisis, right? Many of them have started venture capital funds in the past couple of years, and this is the first real stress test for their portfolios. And I'm sure that the real like well-known and established funds, they'll be fine, and they have lots of capital, and they also have a very clear strategy. But I'm just curious how corporate venture capital funds that just do it kind of like as an aside, as part of the corporate development function, how they will react to this. That's more thought. Don't really have an answer to that. Just curious how they will fare in the next couple of months. That's kind of it from my side. Happy to answer any questions, and thanks, Nina, for taking the time.
Yeah, of course. So I think we have about 23 more minutes. Let's move swiftly into the questions. I'm going to hand it over to Sonia from our team, who is looking at the questions from you all in real time. Thank you for contributing. So Sonia, do you want to take us away with those questions? And we'll probably post them to the group. I would just, if caveat, you don't need to say I agree if you're in the investor and you're on the line. Let's just move forward to new proactive ideas for the group since we are time limited. And over to you, Sonia.
Sure. So I see a couple questions coming through on equity crowdfunding at this time, given lower valuations and a longer process of evaluating deals. How do you, as investors, other banks, or other exit companies view equity crowdfunded ventures? Is this a good strategy in the near term, or will it hurt us in the future?
I can jump on this one. This is Tom Spier from Boulder Food Group again. I don't think it necessarily hurts you to if you need to, raise capital and you can get it done through crowdfunding. I think, good on you. I think it's going to be tough in this environment. I think that given the broad nature of this economic situation, I don't know. I mean, angel investors and folks that are doing that type of investing or supporting companies, even if it's not an investment for some other type of crowdfunding program, I just think that that's gotten harder. So I think you really have to think hard about whether or not it's actually going to get you to where you need to be. Because, usually raising a couple $100,000, it just doesn't get you all the way to where you need to be. There have been some, really successful large fundraisers in equity crowdfunding deals over the years, but again, I think that could be more challenging. So it might be a piece of your overall pie, but I wouldn't expect that you could fill the entire round with equity crowdfunding. Ideally, also, it's not great to have lots and lots and lots of people on your cap table. So if you do it, if there's a way to do it where it's more of like a single member LLC that people are funding into to keep the cap table cleaner, that's probably the best way to do it, just so you don't end up with, you know, a littered cap table.
Yeah, I would also just add that we did say that VCs will be slower to do deals. I think that's a very temporary condition. And I would think, you know, if we get a month out, you know, we're going to kind of be coming out of our bunkers a bit. So unless the need is immediate, you know, VC will still be a channel. It's just going to be, it might take a little bit longer to close. You might have some more cats and dogs in a given round because people won't write, you know, bigger checks solo. And valuation will be a little bit lower, but VC is still an alternative that's available. There's plenty of dry powder, you know, kind of looking to get to work in this market.
I agree, and I would add, I would be creative around some other sources of capital. So there's a lot of city, state, and even some federal funding, small business loans. You know, as Michael mentioned, if you've already had a line of credit or something with venture debt, those are options to explore. I would also be creative around fundraising. So, you know, as has been said, it's going to be difficult to do a traditional fundraising round right now where you're asking for a lead investor to price it. I would go back to your existing investors, you know, your board, and ask, maybe there's an opportunity to open up a round that recently just closed. Were there a set of investors that missed out, or maybe at that time you didn't want to bring on extra capital, your investors didn't want to do that because of dilution? Maybe those circumstances have changed, and it still has a perception of being an attractive valuation to where the company is today. So that's an option to consider, and I'll stop there.
Great, thank you. So the next question is, are there any specific food and ag investment themes that you think will become prominent or get added focus as a result of the COVID outbreak?
Well, maybe quick comments from my side. I heard a lot of good, received a lot of interest, of course, and it wouldn't surprise you in kind of shelf-stable, pantry-like products. Companies like Banza, for example, the chickpea pasta, they're doing great. They're killing it right now. Also, of course, e-commerce. To my earlier point, I mentioned to the introduction, companies able to move sales online kind of seamlessly. They are actually up and have to see a lift in sales, and there will definitely be an interesting companies with a stable market position, whether it's online or brick or mortar. Also, and would be curious to hear from the investors here, but also interested to what I'm also hearing is more like companies that are bleeding a lot of cash. They're of course less in favor at this point. People are just not willing to take as much of a risk at this point. So if you're close to cash neutral or profitable, that is a better position. Of course, it's always a better position to be in, but definitely right now.
As an investor, I'm looking at areas, so still investing across the food supply chain. I think what's a little different is really focused on how is the technology or the business, the offering, delivering real value today to farmers. If it's at the farm level, does this deliver ROI? I think it's going to be challenging to get products across that are risky or at a premium if there's not, you know, clear trials and information that show that return today to an investor or to a farmer rather. Similar in the supply chain, how does this deliver cost savings and benefits to supply chain stakeholders today? Food manufacturing, how do you focus or capitalize on some of the opportunities in today's environment? It's hard to know what the future is going to look like in 2 to 3 years. So it's very hard to underwrite or have optimism in some of those growth assumptions. But if you have products or offerings today that can deliver real value, what are you doing now to capitalize on those?
Great, thanks.
I was just going to say, and just I'll be brief with this comment, just following Amanda's comment, that I think in recent past, there's been a lot of investment in nice to have products and services versus need to have products and services. I think that investors are going to be a lot more focused on investing in need to have, must have products and services, and really clearly understanding what that concrete value proposition is. And so, I mean, it's a way you should always invest, really, but people get away from it during really frothy markets like the past market.
One last comment, just gross margins. You know, companies with gross margins that are healthy, very healthy, extremely healthy are going to be more favorable for investors in this period. You know, if you have a brand that's subscale, that doesn't have strong gross margins today, you know, the line of sight to those margins, it needs to be, you know, 1 quarter, 2 quarters away, maybe 3 quarters. If you're thinking your margins are going to get better in 3 or 4 years, that's going to be a really tough story to tell right now.
Great. So kind of bouncing off of that idea, there's a new consumption trends that are coming from consumers right now. So a question is, what metrics are you watching to understand new consumer habits and identifying what the new normal is?
I think there are other people on this call that are probably better suited to answer this question because I'm more of a tech investor, but I have been thinking, you know, on the go isn't really much of a need anymore. So maybe there's rethinking the at-home dining experience and what that might look like. That could lead to some interesting opportunities for growth and new products and differentiating yourself.
Yeah, I don't know that there are a lot of these metrics are well defined quite yet in this new environment, but I do think a lot of it will come from e-commerce performance and how you are comparing relative to your peers. Just like we've always looked at on the CPG side, it's always about looking at the syndicated data and understanding how the company performs relative to its peer group. And I think we're going to see the same thing. It's just, you know, we're going to need to see those metrics and understand it on the e-commerce side. So if you can clearly articulate how you are outperforming your competition in e-commerce, I think that's a winning set of ideas.
Are you seeing shifts in grocery, direct-to-consumer, or sales channels that you feel will stick around well after this crisis? And then related to that, how are you advising companies to retool around additional digital or tech capabilities to adjust to the current environment?
I mean, yeah, absolutely. You know, if you try to go sign up for any of the home delivery services right now of fresh produce, you join a waiting list most likely. Because they're already taking as much volume and inbound as they can get without even spending anything on marketing. So my view is that a lot of those are kind of people that are just opportunistically trying it out. But even if you just keep a couple of, you know, of that cohort, you know, you're acquiring them for free. So I think there will be a behavior shift towards home delivery and e-grocery that comes out of this, because people will get more used to it. The logistics for it will get better. And there will be kind of an ecosystem that grows up around it. So I do think that is permanent. I just don't know exactly kind of how to judge that yet. I guess the question really is kind of what is month 2, 3, 12 retention look like? And we just don't know that yet.
I would say on the digital technology side, one of the silver linings we're beginning to sort of see is on some of our software technology data businesses. Historically, those have been very boots on the ground sales efforts, especially in agriculture, where there's a lot of value and importance placed on interaction, heavy in-person interaction. And I think what may be a silver lining from this is everyone is getting more comfortable with engaging virtually and working remotely. And so I wonder if we'll start to see some productivity gains with sales team members at some of our companies, and in the industry, and will customers be more open to closing deals without and moving more swiftly to capitalize on opportunities than they may have been previously?
Great, thank you. So do you see this causing food manufacturers to secure or increase investments in their own domestic supply chains? And what other areas of investment are companies looking into to prevent from future supply shocks?
I think there's two components to that. We don't do a ton of CPG, so I'll leave it to the other experts here that kind of know how to do sourcing most effectively for ingredients. But I would say that there's kind of the one thing of kind of finding dual sourcing a lot of your necessity, just so there's kind of contingency planning. But also I think there's a bigger question of just visibility that big CPG brands are going to have and big processors are going to have, and that they don't know where the risk sits in their supply chain right now, even though they'd like to think they do. So, you know, a lot of folks are going to wake up 2 weeks from now and know they can't get XYZ ingredient or XYZ part for whatever machine is not able to be fulfilled because it's manufactured in Northern Italy. And they just didn't see that coming. So I think there actually is a supply chain visibility need that will probably be solved by some sort of software solution in the next couple of years on that front.
And I guess I would say that, you know, this kind of ties back to the liquidity side, and given some of the, you know, increased demand that certain suppliers are seeing or brands are seeing, I think that having the liquidity to really amp up your inventory levels is everything. Obviously, that's easier said than done if you're dealing in inputs that are longer shelf life. If you're dealing in short life inputs, then that's a lot harder challenge. Yeah, I think it comes back to having the liquidity to carry the higher inventory loads.
Thanks. So another question is, as a pre-seed stage company who's raising right now, how would you recommend going about fundraising at this time? And then a second question on top of that is, what changes to investment decks, if any, would you recommend business owners or brands doing right now to communicate the current situation?
Yeah, it's tricky in that pre-seed world. There's, you know, I think given risk tolerance has changed in the last couple of weeks. I think you're really going to the people that you know the best. You know, often these deals are funded by friends and family anyways at that level, unless you're trying to build rocket ships and you need, you know, really significant capital. If you can really prove to yourself that you can get through important gates with capital that really trusts you, the entrepreneur, because of their existing relationships, I think that goes a long way. And then in terms of the material, I think just being, you know, realistic about expectations, especially in the next, you know, 12 months, just because it's going to be really difficult to get placements on shelf when buyers are not taking meetings for new brands, which is a reality. It's a lot harder to get a meeting than it was 6 months ago, or even a month ago. So just having realistic expectations that don't look like you're not, you know, aware of the actual situation on the ground.
I would add, if you're pre-seed, there's probably, I would imagine there's still a lot of exploration and development to be done on the business model plan. And so I would encourage folks to consider accelerators. A number of accelerators will help provide some office space and resources that I think can help you bootstrap for longer, continue to make progress on the business. And again, as things start to, the dust settles over the coming weeks and months, coming out of an accelerator or incubator program, sometimes there's funding through those, and but more than anything, it's the network that's really valuable. And so if you're on the radar and you're being marketed by those accelerators, and you're going to have a lot of eyes on you, and I think be well positioned to fundraise coming out of that program.
I think that if you're pre-seed or even seed, it's likely that you have a very lean team. And I think that that is a huge advantage in today's market now. I think you can be a hell of a lot more capital efficient. I've said it already several times. I would use this as an opportunity to basically go stealth and focus on the business, like Amanda's saying, be super capital efficient. It's maybe just a handful of people, or just you and a co-founder, a couple co-founders, and you just really perform and do the work that you need to do to set it all up so that it's ready for prime time when the time is right. You also have a major advantage in the sense that your earlier stage, that there isn't a valuation trajectory that's already taken place that might have to be revised entirely coming out of this. Some of these companies that have raised several rounds at lofty valuations, they're going to be taking down rounds, very likely. So that's one thing that you might not have to deal with. So I would take advantage of this time, go a little quiet, go a little stealth, maybe raise another family friends round, find, investment partners if you can, particularly those, if they're VCs, that understand the opportunity here and the risk, and will remain committed to the company to carry you through, the next 12 months if possible. Someone who's able to syndicate or carry you through on their own even. And that's the way we're thinking about it too. We're looking at really early stage investments now. We've always been an early stage investor, but we're looking even earlier and sometimes, but we're investing with the mindset, as we always do, with really high conviction, knowing that we're comfortable carrying this company through the next round of financing that they need.
Fantastic. One last question. And some housekeeping. Everyone, we've been looking through the thread. There's a lot of lengthy questions. We've tried to cover as much as we can. I think there's more demand and questions than we can get to right now. So we may think about doing another one of these with investors over the coming weeks. Maybe some of these folks, maybe some new faces. We're really excited to see all of the engagement. But I think one last question someone put on the feed that was interesting and potentially a little bit crass, but it's the idea of never wasting a good crisis. I was on the phone with an investor yesterday who said, she has a food business that's sort of pivoting now, at least interim, to start making hand sanitizer because they have a business that can do that effectively, and they have partners who want that. So I'm curious if there are any examples, quick examples that you all can share without naming names of companies in your network that you think have done something really creative to stand out in this market, to provide value in a new way. And if there's any examples you can share, I think folks on the line would love to hear that.
Sure. I can comment. About 5 of our companies have really have services or products that could be advantageous during this time. So, for example, we invested in a company called Descartes Labs, data refinery, remote imaging analytics company. They quickly started measuring emissions, measuring changes that are happening on a global level to kind of understand the impacts of COVID, and some of that has been covered in the press. Company we recently invested in, Culture Biosciences. Number of solutions are coming to the table, therapeutics and otherwise, that are going to need rapid scale up, and they're a biomanufacturing as a service company. And so they're really rising to the occasion to help accelerate development. Those are just a couple of the opportunities, and sometimes there can be funding associated with those, but they can be really good opportunities to lean into at this time.
Yeah, maybe a quick example from my side. We're currently working with a company that is extracting ingredients from oilseeds into personal care and food products. But that ingredient can also be used in hand sanitizers. So they kind of pivoted from their personal care business kind of towards a 100% hand sanitizer business because that's where the need is. So yeah, that's an interesting example of how they both increase their sales and also are kind of helping with the current crisis.
Yeah, maybe to add from our portfolio here in the Netherlands, we have a company that is focused on providing software and data solutions for indoor agriculture, so mainly horticulture. So they can actually help in remote management of the farming. And one of their big partners is a consultant. So they are globally active in consultancy for horticulture. And they're now looking into actually speeding up that distribution agreement with that partner. Because obviously if the consultants are no longer able to physically go to their clients, then having something that allows them to communicate with their growers from a distance is super relevant. So they're even thinking around, specific, maybe even reduced pricing packages to really penetrate that market super fast. And I think, those kind of opportunities are really out there for other companies as well.
I wouldn't say this is necessarily anything that any of our companies have done yet, but I think in situations where liquidity is really dried up and it's hard for these companies to find a path forward, this might be a good time to consider consolidating with other businesses that are very similar in terms of their distribution strategies and where there's synergies. I think that there will be some consolidation. It probably doesn't work for brands that are too small, but at some scale, I think that will start to be a good path for brands to find a way forward.
Fantastic. I want to say a huge thank you to the investors for being on this call, and probably an even bigger thank you to all of the 80 plus of you that joined in at one point or another today to hear these perspectives. We will be creating content out of what was shared here today, and we will be trying to answer all the questions that you've posed through what we put out through our content channels. So check foodbytesworld.com. We have a resource list for early stage brands. We're sharing community perspectives from startups, investors, and corporates that we work with. We're highlighting our alumni startups across our social channels. And if you do have more specific questions that you want to funnel into the investors that were here today, please feel free to email foodbytes@rabobank.com, and we will do our best to sort through the information and make connections where relevant. We hope that this was helpful and also positive. I think we saw some messages of positivity around people still need to eat. We're all still here. We're going to get through this together today. So I just want to say thank you all for joining. Look back for more webinars from us, and be well, be safe, be healthy. Thank you.
Thanks, everyone.
Thanks. Take care.
Bye.
Take
Thank
care.
you.